Alright, you already know what it is. It's the update video for the Roundhill weekly paying dividend ETFs, QDTE and XDTE. So I've heard so much good news about these ETFs. Man, you'd think these ETFs have some sort of superpowers. It's a miracle ETF. People are like, man, I'm growing my hair back because of these ETFs. My wife stopped cheating on me because of these ETFs. It truly is some sort of miracle ETF. So I have seen a lot of videos about these weekly dividend paying ETFs. So today I will be going over the pros of this ETF. I'll kind of explain how the ETF works yet again. But then I will also be doing this very peculiar thing. Not only will I be giving the pros, but I will also be going over the cons. Oh my gosh, yes. It's as if there are potential downsides to owning ETFs. As with any investment, there is a chance that you could lose your money. All right, guys, let's go over QDTE and XDTE. So the first claim that I've heard a lot of people say is that I'm a retire tomorrow. Guys, do you really think it's that easy to retire? We have people working until they're 70. Did they not know that there's this hot new ETF that pays weekly dividends and can get you 34 to 68% returns or yields every single year, even though the average S&P 500 return is only 7 to 10%. They must not have known about this miracle ETF. All right, guys. So if you're hoping to retire on these weekly dividend paying ETFs, I think that would actually be very hard. Like, you might retire, but your retirement's not going to last very long. For one, their dividends are not always super consistent. Like, sure, they've been paying weekly dividends. That's great. But the dividend amount has widely varied. Is that exactly what you can count on in retirement? Hey, I don't know if I can pay this utility bill. You see, QDTE, they paid a little bit less this week. Guess I gotta go beg for my job at Costco again. And I've seen a lot of people put a lot of emphasis on the weekly aspect of it. It's great when we have companies that pay us quarterly dividends. And it's also super nice that we have a lot of ETFs that pay out monthly dividends. But man, getting weekly dividends, does this somehow change the game? Well, not exactly, right? Like, weekly dividends might be great from a cash flow perspective, right? You're getting paid more frequently, but it doesn't really matter that much, right? Like, if you got paid 30 cents a share and there's 4 weeks in the month, it doesn't really make a difference if you got paid $1.20 from an ETF or 30 cents over 4 weeks. I mean, sure, the cash flowing helps a little bit, but it's not a reason to invest in one ETF or another. You can just do this thing called budgeting, and that way you can actually budget and have money to pay for all your living expenses if you just can control yourself and, actually allocate how much money you need for expenses throughout the month. You don't need to worry about getting paid weekly or not. Also, getting paid weekly, that means that there's more work for these funds to do, and there's already a lot of work for them, right? They're doing options trading. So they're going to have slightly more higher of an expense ratio. That's more administrative fees to give you these weekly dividends. So in a way, you are paying for them. And also keep in mind, these are actively managed, right? So that's why you're going to have that little bit higher expense ratio than something that just passively owns the S&P 500 index or 100 great dividend paying companies like SCHD. I've seen a lot of people hate on some of these yield max fund managers like Jay. They're saying, hey, if you don't
start putting out a fund that pays weekly dividends, I am going to take my business elsewhere, Jay.
Yeah, I'm sure they're super concerned about what some guy on YouTube is saying in the comments that's managed their investing decisions. So I've already seen a lot of YouTube thumbnails and Reddit posts and YouTube comments saying that they're going all in on XDTE and QDTE. Because, going all in on an ETF that has been out a whole 6 months is the best thing that you could possibly do with all of your life savings. All of life's effort and work went into making money throughout your whole lifetime. And what are you going to do? You're going to put it in an unproven ETF. That is so smart. Just remember this about ETFs or companies, right? An ETF or company is never obligated to pay you a dividend. You are not entitled to anything. You are not owed anything. The company or ETF cannot pay you a dividend, and that would be totally okay. Nobody's getting arrested. Nobody's getting indicted because they didn't pay you a dividend. It doesn't matter how much you cry. When a dividend cut happens, just know they don't have to owe you anything. These are still brand new ETFs, and that is definitely a risk. Also, just like, how long is it really going to last you in retirement? Like, retirement these days is 40 plus years, potentially. We got people living way longer nowadays. Can these ETFs that have been out a whole 6 months last you that long in retirement? I don't know. Something about that just doesn't add up. All right, let's get into a little bit more color on how they exactly work. Now, I know a lot of people, when they're researching these ETFs, their sophisticated investing process simply goes, hey, let me filter the dividend yield by the highest yield, and then I'll just buy that company. Believe it or not, there's actually a couple more things that you should be looking at when analyzing a company or ETF, such as, how exactly do they work? What is their trading strategy? I really want to thank Diesel of Seeking Alpha, as this article really helped me research this video. As a reminder, I am a proud partner of Seeking Alpha. Now, the fund will write covered call options on the day they expire, hence the whole 0-day options aspect of this ETF. So let's talk about how this works, right? So let's say we start off the day. Any call options written will happen after the market opens at 9:30 Eastern time. So if the market shoots up with a big positive gain, this is beneficial because the fund is now able to gain some of that upside overnight. Or what if the market starts off super hot, then fades away? Well, that's actually also good news for this fund because they got those juicy premiums. So they're getting overnight exposure to the index that could potentially allow for some big gains, but that doesn't mean that there isn't some risk. Yes, you mean getting a 34 to 67% yield comes with a little bit of risk. Well, there are also going to be days when the market doesn't open super hot. Instead, it opens way in the red. And then it actually does this thing where it recovers throughout the day. Then all of that upside is lost. Also, a major factor of options trading is time decay. So generally, the farther out that expiration date of the option is, the more premium you get. So here, when our options expire on the same day, we're not getting that overnight exposure for the option. All that time decay gets lost. So potentially we're missing out on that income from the option, but the upside is we still get some of those overnight capital appreciation gains. The fund is essentially doing a poor man's covered call, where they're buying an option contract very far out of the money, and to stimulate ownership of the stock, they write short-term calls against it. This allows the fund to leverage its money and gain some upside without actually owning the index, but it does come with some risk. If the index went below the strike price, the fund could lose all of its money. Now, is this likely? Probably not. It probably isn't going to happen, but when people say I'm going all in on an unproven ETF, I really cringe. These investors will be saying, where is my mind? Where is my mind? So again, guys, they're buying deep in the money calls and they're selling out of the money calls for income purposes. They're getting big, juicy premiums that they're paying out as dividends to us investors every week. You can actually see all their daily trades on their company website. As we talked about before, what you're talking about risks with these two Roundhill investments. Of course, with any sort of investment, there is going to be some risk, right? Some of that upside is now capped because of the options trading that we are doing, the covered calls. And also there's a small chance that the entire position can be gone. And then if there's just some big wild swings, especially when the market opens every single morning, there could be a chance of the forbidden word that we all hate to say, but is 100% true and not a myth: NAV erosion. NAV erosion could happen. Now, the NAV erosion on these two ETFs has actually not been bad at all. When they're paying out dividends as fat as these have been, I would have expected to see more NAV erosion, but that actually means the ETF is making money. So let's keep this up. And then, of course, the benefits of owning these ETFs. You get that high weekly income. It's a algorithm-based ETF. It's passive. And that might actually be potentially a bad thing, right? Another thing that people should keep in mind is that when the best traders are doing their options trades, it's not necessarily ran on an algorithm. Like, there does sometimes need to be some rationalization, some emotions that are tied into it. sometimes the best time to do options is not based on an algorithm. And it's also just a different strategy. I love this particular sector just because there's so many income ETFs out there these days, and I don't know of a single one that actually does the same investing strategy. There's so many investing income ETFs out there now, and that's why I love reviewing them, because each one is a little bit different and they all could potentially have a place in one's portfolio. Would I go 100% all in on these income ETFs, especially if you are not anywhere close to retirement or maybe even under the age of 50? Probably not. I think for me, they only make up a small percentage of my portfolio. That's because I'm a younger investor and focusing on growth right now. But that doesn't mean that these two ETFs can't make you potentially a lot of money. They've actually outperformed the overall index since they've been out. So XDTE will be tracking 500 largest companies in the US. That's the equivalent to the SPY. So SPY has been up 7.44%. XDTE launched in March. Meanwhile, that particular ETF is up a whole 8.64%. So a $10,000 investment has grown into almost $10,900 with XDTE, and then SPY's investment is just slightly below that at $10,744. Now it's the same case with QDTE and the index that it tracks, the triple Qs. It's kind of funny that this website put 4 Qs instead of 3, but also it's not as funny as on QDTE's website. They don't want to pay the licensing fee for using the NASDAQ 100, so they just call it the Innovation 100. So they have a total return of 4.92% compared to the triple or the quadruple Qs at 3.8%. So a $10,000 investment for the quadruple Qs has turned into $10,380, and then for QDTE, $10,000 has turned into $10,000 and $492 with QDTE. So again, guys, these funds are still relatively new. The outperformance is there so far, but that doesn't necessarily mean it's going to last forever. It probably won't regrow your hair, probably won't stop your wife from cheating on you, but there is a chance that this could propel your portfolio. It could line up your pockets, and it could have you check out our Discord. That's where we're having some great conversations talking about these income ETFs and other strategies to grow rich. Make sure you're subscribed. Make sure you're checking out the podcast at the Collect Cash podcast name. Let me know what you think about these two ETFs in the comments below, and I will talk to you on the next one.
I got to do a calculation. So 1,000 share, $1,000 divide by Tesla, Coney, Misty, divide by 3.